Hey traders, Raghi here. And a lot of times we watch videos and usually the videos are examples of the indicators and the setups and the strategies all going right. But what about when you're wrong? How do we control risk when we are day trading? We're going to talk about the NASDAQ here. I'm going to walk you through a trade that did not go as expected. Knowing your risk up front, having a simple, quick way to measure that risk and determine where you will or won't take a trade and what you're expecting to help hold the trade to levels of validity. All these things have to be done. I mean, it sounds complicated, right? But it doesn't have to be, nor really can it be. So I'm going to walk you through how we gauge a trade for setup, and then what happens if it doesn't do exactly what we hoped it would. So this is a setup that I took. This was the NASDAQ. Started off with bearish directional bias, bearish sentiment. So as we were moving lower, look at this gorgeous double red downtrend. Well, sometimes certain indices just decide that they're going to be the stronger one for the morning, for that particular session, for a period of time, what have you. And the NASDAQ looked like it was going to be a nice weak trade. And in this zone in here, it looked like a great short. Now look at that sudden move. I'm going to show you right here. So here's the NASDAQ heading lower. And there's a couple ways that this could have been managed to not let it turn into a loser. But I don't want to emphasize that, but I do want to mention for those of you that understand how to break things down to scaling out at different levels, right? This is your first opportunity. This will be your second opportunity, third, as it keeps going lower. I'm just kind of mocking that out. There's a pretty good chance that a little bit more of an aggressive profit target could have helped me, but here's the fact of the matter. I didn't have one in. I was looking for about a 11,403 exit. And again, these were all placed in the notes. I was looking at the NASDAQ and thought, you know what? This would be an interesting opportunity to get short. So I did. Moving nicely lower, great resistance in the wave, double red. We play probabilities and not certainties, gang, and this is just the way these things go. It tagged the wave, right? You see I've noted that, put a little image in there. Then what happened? Did it hit 11,403? Nope, it just shot up. Now, we had a 10 o'clock hot zone, the factory orders, which is a pretty low impact number. You've got to know the day trading clock, and off it went. All right, notice what I've highlighted here, and I'll do this in the room with the traders. So this area here, I'll make it a little bit bigger so you can see it. That's the wave. That's where we build the short position, which you can see with the 945, 950, and even in the 955 candle, which syncs up with the notes here, we had an opportunity to do. Started moving lower. Never got, now I will say, we got so close. I think we were within about 2.25 points of my target. This happens sometimes. It does happen sometimes. And it just shot up higher. Notice this red zone. This red zone, if you can see right here, is the allowable amount of risk for this trade. Now, I based that red zone on basically the range and a certain degree of volatility using tools on this screen. So I'm not going to get into that in this video, but rest assured, if you can look at the distance between moving average lines, if you can look at the distance between key levels, it's pretty easy to just say, all right, this is the width I'm dealing with. And what I like to say, shadow the zone. So on the other side of the zone, much like a shadow, we place that level. And here it is. Got stopped out, knew where the stop was. Now, some folks might say, Rob, could we have given to 11, just above 11.5? What if we stalled out there? Certainly could have. But here's the issue. If we run stops through 11.05, it's all, or 11.5, the major psychological level, we get through the 0.5 level of that, it's almost a beeline to the minor psychological level at 20, okay? These are things that I teach in day trading. Major and minor psychological levels. So there was really not a whole heck of a lot of reason to have anything above around 95 to even 90. It could have been far, far less, even just putting a stop at 90 to get out. But look how much we were risking, or how, if you want to look at it, how little. You get to choose. This is what's so important. You want to enter aggressively, more moderately, or conservatively. That's a decision you can make, knowing where the lines and levels are. And then depending upon what your allowable amount of risk is to that level, notice how the risk is going to determine which one of these entries you can take. This is what risk management is all about. Being able to know your risk, position yourself in a way that the risk is not overwhelming for your account, and accept that there are going to be losses, but we keep them to paper cuts so we could take advantage of new opportunities happening on other time frames. And that, keeping that heads up approach in day trading, is going to be the difference between being really frustrated and having a productive day trading career.